Have you ever wondered how some people seem to build wealth effortlessly, as if guided by an invisible hand? It's not magic. It's a force of nature, a principle so powerful that Albert Einstein supposedly called it the eighth wonder of the world. This force is compound interest, and understanding it is the first step toward unlocking true financial freedom. Imagine a tiny seed. With just a little soil, water, and time, it sprouts. That sprout grows into a sapling, which eventually becomes a mighty, towering tree. This is the essence of compounding. It's the ripple effect that starts with a single drop, expanding outward with ever-increasing momentum. It's the unseen force that can turn small, consistent efforts into monumental wealth over time. So what exactly is compound interest? Let's break it down simply. Imagine you have some money, your initial capital. When you earn interest on that money, simple interest means you only earn it on your original amount year after year. It's steady, but it's slow. Compound interest, however, is a game changer. You earn returns not just on your initial capital, but also on the accumulated interest from previous periods. Your money starts making money, and then that money starts making its own money. It's a self-perpetuating cycle of growth that accelerates dramatically. The mechanics of this growth are driven by a few key elements. First and foremost, time is your greatest ally. Think of a graph showing your investment's growth. For the first few years, the line might climb slowly, almost disappointingly. But as the years turn into decades, that line begins to curve upward, steeper and steeper, creating an exponential explosion of wealth. This is why starting early is so crucial. Consider two investors. Sarah starts investing $100 a month at age 25, while Tom starts investing $200 a month at age 35. By the time they both reach 65, Sarah, who started earlier with less, will have significantly more wealth than Tom. Every dollar you invest is like a worker, and by reinvesting your earnings, you're constantly adding more workers to your financial army, all laboring to build your fortune. This powerful principle isn't just a theoretical concept, it's at work all around you. It's the reason your high-yield savings account grows a little faster than a standard one, as interest is added to your balance and begins earning its own interest. It's the engine behind long-term investments like stocks, bonds, and mutual funds, where dividends and capital gains are reinvested to fuel further growth. However, this force has a dark side. Compounding also works against you with high-interest debt, like credit cards or payday loans. The same exponential principle that builds wealth can just as easily dig you into a deep financial hole if you're not careful. Harnessing the power of compound interest for your benefit is surprisingly straightforward. The formula is simple. Start as early as you can, no matter how small the amount. Be consistent with your contributions, making investing a regular habit. Cultivate patience and resist the urge to react to short-term market noise. Let time work its magic. Finally, be mindful of fees, as they can silently eat away at your returns and hinder the compounding process. By making smart, informed decisions and using the right financial tools, you can put this incredible force to work for you. This isn't a secret reserved for the wealthy. It is a universal principle accessible to everyone. The power to build a secure and prosperous future is within your grasp. It begins with a single step, a single dollar, and the decision to let the eighth wonder of the world work for you. Take action today, plant your financial seed, and watch as the power of compounding helps it grow into the future you've always dreamed of. In a world of constant motion, where skylines pierce the clouds and digital transactions flicker across screens in the blink of an eye, an unseen hand guides the flow of commerce and capital. It's a force we interact with daily, yet its true power often remains hidden in plain sight. We see banks as places to store our money or get a loan, simple brick-and-mortar institutions or slick mobile apps. But beneath this veneer lies a complex machinery that doesn't just participate in the economy, it actively shapes and controls it. This is the story of how the banking system, from local branches to towering central institutions, wields an influence so profound it dictates the rhythm of our economic lives. The core function of a bank appears straightforward. It acts as a trusted intermediary. You deposit your savings and the bank pays you a small amount of interest for the privilege. It then lends that money out to others, a family buying a home, an entrepreneur starting a business at a higher interest rate, earning a profit from the difference. But the reality is far more dynamic. Through a mechanism known as fractional reserve banking, banks are empowered to create new money. When you deposit $1,000, the bank is only required to hold a fraction of it, perhaps $100. It can then lend out the remaining $900, which is deposited in another bank, and the process repeats. This cycle of lending doesn't just move existing money around, it multiplies it, expanding the total money supply and fueling economic activity. At the apex of this financial hierarchy stand the central banks, the maestros conducting the entire economic orchestra. Institutions like the U.S. Federal Reserve or the European Central Bank hold the baton of monetary policy. By adjusting the benchmark interest rates, they can either encourage or discourage borrowing and spending. Lower rates make loans cheaper, stimulating the economy, while higher rates do the opposite, helping to curb inflation. They also possess powerful tools like open market operations, buying or selling government bonds to inject or withdraw cash from the system, and can resort to large-scale measures like quantitative easing to navigate economic storms. These decisions, made behind closed doors, ripple through every corner of the global economy. If central banks are the conductors, then commercial banks are the first violins carrying the melody to the public. Their lending decisions are the primary engine of economic activity. When banks decide to loosen credit for a specific sector, like technology or green energy, capital floods in, fueling innovation and expansion. Conversely, if they tighten lending standards for real estate, the construction and housing markets can cool down dramatically. This power to allocate capital determines which industries thrive and which stagnate, effectively steering the direction of national economic development and channeling investment toward what they deem creditworthy. This immense power has a direct and tangible impact on our everyday existence. The interest rate on your mortgage, which determines whether you can afford a home, is a direct consequence of banking policy. The availability of small business loans dictates the pace of job creation and the vibrancy of our local communities. Even our personal financial habits, how we save, how we spend, and our access to credit for education or emergencies, are fundamentally shaped by the services, fees, and incentives offered by the banking system. History, however, has shown that this powerful system is not without its vulnerabilities. The failure of major banking institutions triggered a domino effect that plunged the world into a deep recession, highlighting the critical need for robust regulation and oversight to prevent such systemic risks from threatening the stability of the entire global economy once more. In the end, understanding the banking system is to understand the very currents that shape our modern world. Its influence is not a distant, abstract concept, but a present and powerful force in the lives of billions. It is a system that holds the keys to both immense prosperity and devastating crises. By peeling back the layers and recognizing the profound control it exerts, we can begin to engage more critically with its role in society and question how this power can be best harnessed for the collective good, ensuring a more stable and equitable future for all. That shiny piece of plastic in your wallet, it feels like a superpower, doesn't it? A key that unlocks a world of instant gratification. From the latest gadgets to dream vacations, advertisements paint a picture of effortless spending and boundless rewards. But behind the convenience and the alluring promises lies a carefully constructed system. This system, designed by financial institutions, isn't just about making your life easier. It's a sophisticated trap designed to ensnare millions in a cycle of debt, turning your financial dreams into a source of their profit. The mechanics of this trap are brilliantly simple yet devastatingly effective. It all begins with high interest rates, often soaring above 20%. When you carry a balance, this interest compounds relentlessly, causing your debt to grow at an alarming speed. A small purchase can quickly morph into a much larger financial burden. Then comes the illusion of the minimum payment. Lenders present it as an affordable option, but it's a clever deception. These tiny payments often do little more than cover the interest accrued that month, barely touching the original amount you owe. This ensures you remain in debt for years, sometimes decades, continuously feeding their revenue stream through interest charges alone. On top of this, a minefield of fees awaits. Annual fees for the privilege of holding the card, late payment fees for a minor slip-up, and over-limit fees for exceeding your credit line. Each one is another small cut, draining your finances while boosting their profits. But the trap isn't just financial, it's psychological. Credit cards exploit our natural desire for instant gratification. Why save for months when you can have it now? This short-circuits the brain's natural saving impulse, replacing discipline with the immediate high of a new purchase. This creates a dangerous disconnect between spending and the actual cost. as swiping a card feels far less significant than handing over physical cash. The result is a phenomenon known as perceived wealth, where the credit limit is mistaken for actual money in the bank, leading people to live far beyond their means. To further encourage this behavior, companies have gamified spending through rewards programs. Earning points, miles, or cashback creates a dopamine loop, making you feel like you're winning a game when in reality, the house always wins by encouraging you to spend even more. Once you're caught, the descent into the debt spiral can be terrifyingly fast. What starts as a manageable balance from a few unexpected expenses can quickly snowball: a car repair, a medical bill, and soon you find yourself using one credit card to pay off another. A desperate juggling act that only sinks you deeper. The numbers on your statements climb, and a feeling of being overwhelmed sets in. This isn't just a financial problem. It becomes a heavy emotional and mental burden. The constant stress can poison your relationships, affect your performance at work, and lead to anxiety and depression. Your credit score, the key to your financial future, takes a severe hit with every late payment and every dollar of increased utilization. This damage can lock you out of major life milestones, making it nearly impossible to secure a loan for a home, a car, or even pass a background check for a new job. However, escaping this trap is entirely possible. It begins with taking control. The first step is creating a detailed budget and meticulously tracking every dollar you spend. You cannot manage what you do not measure. Next, you must commit to paying far more than the minimum payment each month. Strategies like the snowball method, where you pay off the smallest debts first for psychological wins, or the avalanche method, which tackles the highest interest debts to save money, can accelerate your journey out of debt. Crucially, you must stop adding to the problem. This might mean physically cutting up your credit cards and switching to a debit card or cash for all purchases. If the situation feels insurmountable, there is no shame in seeking professional help from a nonprofit credit counseling agency who can help you negotiate with lenders and create a viable repayment plan. Ultimately, the power to break free lies in understanding the game. Credit cards are not inherently evil, but they are tools that must be handled with extreme caution and discipline. By recognizing the psychological tricks and financial snares, you can shift from being a pawn in their profit scheme to the master of your own financial destiny. Reclaiming your financial freedom isn't just about paying off balances. It's about restoring your peace of mind and building a future where you are in control. It's about achieving a life defined not by what you owe, but by what you can truly afford and genuinely enjoy.